Is Ben Oberg a scam artist? Had a couple people make some spin-offs of some videos that went viral. We had the most viral video in 2025 to this point on infinite banking and how to become your own bank. So I got all the questions, the things they called me out for here. And it's just crazy because people must think I don't have access to this information and looking y'all up and knowing, you know, the products that you have access to. So is Ben Oberg a scam artist? Let's answer this from Ben Oberg's biased point of view. When it comes to infinite banking, insurance products, things of that nature, I had a couple people that made some spin-offs of my videos, called me out on a bunch of stuff, said I was inaccurate with several points. If you're watching this, the takeaway that I have for you guys is always verify the information that you're getting and make sure when you're going to make an investment, you're getting into life insurance, you're trying to build cash value, you want to become your own bank, you want to understand investments or assets, make sure the person that you're talking to knows what the they're talking about. Make sure they use their own products. Make sure they practice what they preach. Make sure they actually invest in real estate, invest in oil, all the things that I talk about. Own gold, own silver, have lines of credit against their gold and silver, all right? Pay very little taxes. Make sure they actually do that, all right? So here's a good one. I said in one of my videos, the type of life insurance policy I have, dividend paying, high early cash value, institutional grade whole life insurance policy. I specifically said only a few dozen agents can sell this product. The reply that one of these individuals publicly said on their video, no, any agent contracted with Mass Mutual can sell this high early cash value policy. It's not exclusive. That would be false, okay? There's a difference between institutional insurance and retail insurance. Most advisors sell retail insurance, okay? i.e. pay until age 100. That's not what we're doing here in the capitalist network, okay? They mask it with paid up additions and call it high cash product. There are only a handful of professionals that have access and can actually offer institutional insurance products that are set up for asset-based accumulation and payout to the advisor. They don't have huge upfront commissions, okay? These are typically like 10%. They're not your 50 to 90% commissions like this gentleman that called me out is probably making. If you want to learn about these, message me, right? Here's a really good one. I've made several videos. By now, you've probably heard me say this multiple times. I said 8 to 12% IRR is what these policies can get. But first of all, have you ever heard of survivorship policies? Survivorship policies can be even higher, okay? Within a few years, they could be more like 12 to 15%. Within a few, if you know what the number few is, a few, it's usually gonna correlate to 5, okay? Survivorship policies can be upwards of 12 to 15%. Maybe you should acquire enough of a net worth to open up a survivorship policy, all right? And then you'll probably have to make another video, right? So I said 8 to 12% IRR is what these policies can get. The response that this gentleman made, and again, I'm not trying to battle it out. I will, if somebody's brash enough, I absolutely will call them out. I was thinking about including edits of the video that they made, but y'all, I'm sure, can find them, and I decided not to. But what I did do is I transcribed all of the accusations they made of me, and that's what I'm going over here. So I said 8 to 12% IRR is what these policies can get. Their response, not true. Real IRR on a HEC V is closer to 4 to 5%, and is sometimes lower due to the design prioritizing early liquidity over long-term yield. Again, in retail life insurance, you are correct. In institutional, the insurance carrier is going on the long yield curve, all right? They're investing in private equity, in real estate, probably the things you should learn about, and getting a higher rate of return than on retail products. Additionally, that coupled up with a lower cost of insurance, therefore able to offer a higher IRR. Again, this is based on my personal policy and my personal life, and it depends on everybody and what your age is and what your goals are and how the policy is designed, but that's my personal experience. I also mentioned that I exchanged an old policy into a better one to put more money in. Makes no sense, they said. If his policy truly gave 10% return and 5% cost to borrow, he'd keep that original one running, not swap it. I don't understand the stupidity in this remark here. If I started off with a policy that had $10,000, $15,000, $20,000 of cash value, and I want to overfund that policy, there's what's called a MEC limit, MEC, Modified Endowment Contract. In layman's terms, typically you can only overfund a policy of such nature by 2.5 to 3x the original amount. So if I started off with $20,000 of cash value, I'm probably only going to be able to fund it up to 50, 60K before I hit that MEC limit, and I can no longer contribute cash value to that policy. So obviously, if I was approaching that, I would take the cash value out of that policy and I would 1035 exchange it into another policy so that I could start off the new policy at a higher amount, so that the MEC limit would then be an even higher amount. If I have 50K starting off and my MEC is going to be at 150K, I'd rather have that than less leverage at 60K. So maybe just learn how math works, right? I also said this strategy works because of arbitrage. Borrow at 4 or 5%, earn at 10. Misleading. This assumes perfect conditions, ignores loan cost fluctuation, and isn't guaranteed. There are no cost fluctuations in mutually participating whole life insurance, okay? I think you're confused by retail universal life. And again, my examples are based on what I have done. And fortunately, I know a lot of people that do this, okay? And like, I don't want to be an ass, but I have a problem with people that think they're God's gift to the financial world and have been misinformed. And you only know so much. Like, look, I invest in things that 2.5, 3x, sometimes even 3.5x in a 5-year period, all right? I know people in sectors that will not invest in anything that do less than 6x. I don't know those sectors. I don't have that knowledge. Luckily, I know people that do, and I invest there and with them as well, okay? But if I personally possess the knowledge of how to 6x, and I will when I get there, then it would put my current knowledge in an inferior standpoint, wouldn't it? And when you start understanding these things about these institutional grade HEC Vs with 8 to 12% IRRs, you'll stop selling what you're selling and stop promoting what you're promoting, all right? Ben said you can only access this via my exclusive network. I did not say that. I said that in my network, we have access to this. And since there's only a select few advisors that offer this and only a couple that I know and personally work with and trust, they're partners in my network. And so that's what I said and that's what I meant. Ben talked about my community, the Capitalist Network. The Capitalist Network is a paid community. It's $97 a month. We offer a 7-day trial. Ben said it's free to join 7 days, then $97 a month. This is misleading. You must enter your credit card in. Most people likely forget to cancel. Well, we send emails out several times leading up to that saying, hey, you're about to be charged, you're about to be charged, you're about to be charged. Now, to just give you a little bit of a lesson about marketing, when you have a digital offer and you have a free trial, oh, and mind you, when they show up to that free trial, I've been doing one-on-one meetings with them, which they've not paid for at that point. We do group meetings. We get them on a live investor power hour call. They're able to participate and start working directly with myself and our partners and access information that cost me hundreds of thousands of dollars and hundreds of thousands of mistakes in the form of dollars. And they're getting that all for free, okay? And because they get that for free, we have a very low cancellation rate and a very low churn. And something else you should know about paid online communities. If you have less than a 15% churn in an online subscription community, you're doing very well. We have less than half that, right? Why do we have less than half that? Because we show up, we're ethical, we're honest, we do what we say we're gonna do. What else? None of this is available from your advisor, I said. Yeah, I would say that's pretty true, pretty true. Please find, there's maybe 3, 4, 5 advisors out there if you search really hard. There's maybe a few advisors that you could get in touch with that understand private equity and business investing and taxes at a high level and 0% strategies and leverage and real estate and oil and natural gas and horizontal oil drilling, and can also sell you institutional grade dividend paying whole life insurance. So when I said none of this is available from your advisor, that's probably pretty accurate, right? Maybe if you focused more on your business, you'd make money. Okay, let's see, what else do we have here? Another video. This is great. And I want you guys to just pull stuff from this so you don't make these mistakes and you're not misled by the wrong people. Ben said, IULs have hidden insurance costs. Not true. IULs transparent in cost breakdowns and whole life. If anything, he should have said they can increase, not that they are hidden. Here's the thing. The costs tend to be transparent in IULs. However, most of the advisors that sell them are not, okay? A really easy sales tactic is to offer refund guarantees, or if you don't like it, I'll give your money back, or to bonus stack the shit out of something. People's attention focused on the good while not talking about the bad, so you can get that 50 to 90% commission on that first year's annual premium, right? What else did we say? Ben said IULs only grow 4 to 6%, which is terrible. Not accurate. Whole life, which Ben promotes, gets similar returns. If 4 to 6 is bad for an IUL, then the same logic would apply to whole life. Well, that's why I'm used to getting 8 to 12%. So yes, your IUL sucks. Ben said I get to borrow against my policy and still earn growth. Not how it works. Caleb says, this is a gentleman named Caleb that made a video. Cash on cash arbitrage is not the reason to use infinite banking. Most legitimate experts don't sell this way. I'm not selling on that. By the way, I'm not selling this. I don't sell life insurance. I'm explaining that there's a compound effect to building wealth, and that arbitrage opportunity allows them to borrow money from their own money, and that arbitrage opportunity allows them to borrow money at little to no cost. Coupled with investing into assets that cash flow and pay them more return, they can pay that line of credit back, that interest-only line of credit back, very quickly, lower their cost of borrowing money even more, repeat the process, level up that line of credit because their cash value has increased, and do it again. Now, if you're not explaining that, you're probably broke. You probably don't have assets. You probably haven't built wealth. If you don't understand or know that, and that's not part of a benefit, then you're not given the full picture, are you? You're not illustrating how much leverage, how much potency there can be with it, all right? Walt Disney probably slapped the shit out of you. JCPenney, Ray Kroc, Nelson Nash probably spank you on the ass and throw you in a prison cell with Bubba. Hey, Caleb, you make good content. I'm sure you're a good creator. I don't personally know you. That's just my humor. But, you know, I educate myself as much as I can on this stuff, and I speak from having done it, not from what my brokerage or my FMO or Lafayette tells me. I also said this product is better than FDIC insured bank accounts. That's misleading. Caleb agrees insurance is safe, but overselling this comparison adds unnecessary hype. You do realize that this industry is regulated, and that at any given point, these insurance carriers have to be able to cover the death benefit or the cash value. They have to have that, right? And FDIC only insures up to $250,000. But what if you have $500K, $800K, $1 million, $5 million of cash value? FDIC isn't going to cover that. It'll be covered here. Ben said, I can teach you how to become your own bank and beat inflation easily. Oversimplified. Strategy is more nuanced. Well, if you want to talk strategy, you should start getting into the institutional grade, right? And again, this is retail versus institutional. IUL and VUL versus whole life. Institutional grade whole life. Financial advisors don't know this exists. False. Plenty of advisors know they exist. No, there's only a few that have access to these. Ben said, real estate and oil give me infinite returns using this strategy. Buddy, yeah, because I understand where I'm investing. You cannot get returns in every market like this. You get them in red areas. You get them where there's year-over-year rent growth. You get them, understand the asset, dude. Understand what the you're talking about. Do you understand oil? Do you understand the difference between a vertical well and a horizontal well? Do you understand how AI puts a premium and causes natural gas prices to go up? Do you understand that some oil wells have 60% natural gas and 40% oil, or the other way around? Do you understand that some are just getting natural gas? Do you understand that water is a byproduct of drilling for oil, and that's a cost that you have to account for? Do you understand all of the tax incentives around oil, depletion allowance, and tangible drilling costs, writing off 80 to 100% of the investment capital in the year that the wells are drilled? Do you understand that tangible drilling cost deductions can be 100% depreciated, whereas last year it was 40% and the rest had to be over 5 to 7 years? We can battle this out all day long. I know what I'm talking about because I do it, and I'm not incentivized to sell it by a carrier that made some training, and I took a little test, got 25 out of 30 questions right, and I got to get a little plaque that says I'm an insurance advisor now. This is what I do, not what I just teach. If anybody has any questions or comments, let me know, and we'll see you in the next video.